the portfolios that I saw when I got to Yale failed the basic common sense tests of diversification and equity orientation, and it prompted me and my colleagues to go down a different path, to put together a portfolio that had reasonable exposure to equities and put together a portfolio that was sensibly diversified. So I'd like to talk about how it is that we got from where we were in the mid-'80s to where we ended up in the early to mid-'90s and where we remain today. And to do that, I'd like to put it in the context of the basic tools that we have available to us as investors. And these tools are the tools that you can employ if you're managing your portfolio as an individual, or the tools that I have to employ when I'm managing Yale's portfolio as an institutional investor. And they're basically three things that you can do to affect your returns. First of all, you can decide what assets you're going to have in the portfolio and in which proportions you'll hold those assets. So that's the asset allocation decision. How much in domestic stocks, how much in foreign stocks, how much in real estate. If you're an institutional investor, how much in timber, how much in leveraged buyouts, how much in venture capital. Fundamental decision of how it is that the portfolio assets are allocated. The second thing that you can do is make a market timing decision. So if you've established targets for your portfolio, targets with respect to how much in domestic stocks, how much in domestic bonds, how much in foreign stocks, and then because in the short run you think that, let's say, domestic stocks are expensive and foreign stocks are cheap, you decide to hold more foreign stocks and less in domestic stocks. That bet, that short-term bet against your long-term targets, is a market timing decision. And the returns that are attributable to that deviation from your long-term targets are the returns that would be attributable to market timing. And the third source of returns has to do with security selection. So you've got your allocation to domestic equities. If you buy the market, and the way that you buy the market is to buy an index fund that holds all of the securities in the market in the proportions that they exist in the market. If you buy the market, then your returns to security selection are zero because your portfolio is going to perform in line with the market. But if you make security selection bets, if you decide that you want to try and beat the market, then that bet or that series of bets will define your returns attributable to security selection. So if you decide that you think the prospects of Ford are superior to the prospects of GM, well, you want to overweight Ford and underweight GM, and if that turns out to be a good bet and you're rewarded because Ford outperforms and GM underperforms, then you have a positive return to security selection. If the converse is true, then you have a negative return to security selection. But one of the really important facts about security selection is that if you play for free, it's a zero-sum game, right? Because if you've overweighted Ford and underweighted GM, there has to be some other investor or group of investors that are underweight Ford and overweight GM, because this is all relative to the market. And so if you're overweight Ford and underweight GM and somebody else is underweight Ford and overweight GM, well, at the end of the day, the amount by which the winner wins equals the amount by which the loser loses, and so it's a zero-sum game. But of course, if you take into account the fact that it costs money to play the game, it turns into a negative-sum game, and the negative sum is the amount that's siphoned off by Wall Street, right? And Wall Street takes its pound of flesh in the form of market impact and in the form of commissions, in the form of fees that are charged to manage the portfolio actively. And then sometimes there are even fees to consultants to choose the managers. So there's an enormous drain from the system that causes the active investment activity to be a negative sum game for those investors that decide to play. So with that background, let's revisit the criticisms that Barron's leveled at the Yale model and the Swensen approach. First of all, they talk about diversification failing. And the fact is that in a panic, only two things matter: risk and safety. And I saw this in 1987, saw it in 1998 with the collapse of long-term capital, and saw it in 2008 in a way that was even more profound than in 87 and 98. Investors sold everything that had risk associated with it to buy U.S. Treasuries. Safety was all that mattered. And of course, in that narrow window of time, diversification does fail. The only diversification that would matter in that instance is owning U.S. Treasuries. But if you owned a substantial amount of U.S. Treasury bonds, and what's a substantial amount? 25, 30, 35% of your portfolio, then under normal circumstances, under the circumstances in which we live most of our lives, you're paying a huge opportunity cost. So you could have a portfolio with 30% in U.S. Treasuries, and year in and year out, you would pay this opportunity cost. And then when the crisis comes, you can be happy for 6 or 12 or 18 months, and then you go back to paying the opportunity cost. And I would argue that if you expand your time horizon to a sensible length of time, that the strategy where you hold relatively little in the high opportunity cost U.S. Treasuries is the best strategy for a long-term investor. And there are those who say that, well, if diversification doesn't protect you in times of crisis, what does it matter? Why would you want to diversify? Well, think about Japan. If you were a local Japanese investor, you wanted to have an equity bias in your portfolio, so you owned lots of Japanese stocks. In 1989, at the end of the year, the Nikkei closed at about 38,000. At the end of 2009, 20 years later, the Nikkei closed at 10,500. So with your long time horizon and equity bias in your portfolio over 2 decades, you would have lost 73%. So diversification makes an enormous amount of sense in the long run, even if there are occasional panics where you're disappointed that the diversified approach that you had to managing the portfolio didn't produce results. The second criticism, overemphasis on alternatives. Let's just look at the last decade in Yale's portfolio. Over the 10 years ended June 30th, 2010, domestic equities produced returns of negative 0.7% per year. Bonds produced returns of 5.9% per year. Let's look at the alternatives as opposed to domestic marketable securities. Private equity, 6.2% per year. Real estate, 6.9% per year. Absolute return, 11.1% per year. Timber, 12.1% per year. And oil and gas, 24.7% per year. I think the numbers speak for themselves. If you have a sensibly long time horizon, these basic principles of equity orientation and diversification make an enormous amount of sense. And if you look at the bottom line, which is performance, when I began managing Yale's endowment in 1985, it was less than $1 billion. The amount that we distributed to support Yale's operations that year was $45 million. For the year ended June 30th, 2010, the endowment stood at a little bit above $16 billion, and the amount that we distributed to Yale's operations was $1.1 billion. So an enormous change over enormous positive change over 25 years.